Hi CA students, let's revise CA Final AFM Chapter 6 Portfolio Management. Practical question 7. An investor had decided to invest 1 lakh in the shares of two companies, namely ABC and XYZ. The projections of returns from the shares of the two companies along with the probabilities are as follows. The projections of returns are given along with the probabilities also, and you are required to comment on return and risk of investment in individual shares. So comment on risk, we can first we have to take the expected return, then we can compare, and risk is nothing but the standard deviation. The second requirement is compare the risk and return of these two shares with the portfolio of these shares in equal proportion. So the second requirement is portfolio risk, so standard deviation of portfolio, and proportion is also given 50%. Then the third requirement is find out the proportion of each of the above shares to formulate a minimum risk portfolio. So which is nothing but at what proportion if we take, or at what proportion if we invest in ABC and XYZ, will get the least risk. So the first two requirements are same as the previous questions which we have already seen. So please watch the previous videos to get the detailed understanding of how standard deviation works, and then variation, then covariance, correlation, coefficient and all. We'll directly see what is this minimum risk portfolio here. So the first requirement is nothing but return and risk, which they have calculated by expected return. The summation of the returns multiplied by the probability will give us the expected return. For ABC it is 12.55, and for XYZ it is 12.1. so the return is more in case of ABC. And risk also, the standard deviation. So we need to take the expected return, then reduce it with the returns, multiplied with the square the difference, multiply with the probability, and the summation will give us the variance. 167 in case of ABC and 126 in case of XYZ. Then the root of the variance will give us the standard deviation. In case of ABC it is more, so the risk is more in case of ABC, and the return also is more. Now the risk of portfolio, same way we have to just take the weights, and as we have done in the previous problems, we can use the formula of a plus b the whole square equal to a square plus b square plus 2ab, and here a square will be the weight multiplied by the standard deviation the whole square, or weight square multiplied by variation. So this will be the a square in our case, and this will be the b square, and this will be 2. And here what they have done is, so inner and correlation of AB. So since we know the covariance, okay, they found out the covariance of A and B, and then they have taken, so the 2 into weight of ABC multiplied by standard deviation of ABC, then weight of XYZ multiplied by standard deviation of XYZ multiplied by covariance of ABC XYZ. So the standard deviation of ABC multiplied by the standard deviation of XYZ multiplied by the covariance of ABC XYZ, this will be equivalent to covariance of ABC and xyz. So leaving with us 2 into weight of ABC multiplied by weight of xyz multiplied by the covariance. So along with a square plus b square plus 2 into weight of ABC weight of xyz multiplied by covariance, that's what they have also followed. 2 into weight of ABC weight of xyz 144 is nothing but the covariance which they have found out. Now here they have found the standard deviation of the portfolio which is nothing but 1.25, and here also as we can see the standard deviation of individual returns is more and the portfolio standard deviation is less. This is because of the diversification. The risk will reduce when we diversify in different stocks in a portfolio. The expected return of the portfolio is nothing but the weighted average, which will come up to 12.325. Hence the return in 12.325% with the risk of 1.25 for the portfolio. Thus the portfolio results in the reduction of risk by the combination of two shares. Now the third requirement, find out the proportion of each of the above shares to formulate a minimum risk portfolio. So we can simply do a reverse calculation also, wherein as we know that risk of ABC and XYZ, and if we apply in our formula a square plus b square plus 2ab, and if we do reverse calculation, and since we need the weight, so if we know the weight of A, then weight of B will be nothing but 1 minus weight of A, correct? If the weight is 40% in case of A, then obviously balance 60%, as there are only two stocks in the given portfolio. So the same way for weight of B, we have taken 1 minus weight of A, but this will also give us the same result. So since we know the risk of the portfolio, we can keep the risk of the portfolio on the left hand side, and if we substitute all the values whatever we found out, but here we have to apply the quadratic equation at one point, because here we'll get the resultant like this. So we are getting a weight of 43% in case of A and 56% in case of B. But this was a big formula, and not a big formula, but the derivation and everything looks too complex. So ICAI has given us a formula to directly find out the minimum risk portfolio. So that formula will be this: the variance of XYZ minus the covariance of ABC and XYZ divided by the variance of ABC plus variance of XYZ minus 2 into covariance. So this is a derivation of this is found out by some differentiation with the existing same formulas whatever we did. Since we have the squares, they did differentiation to arrive at this formula, which is a simpler method. We can also follow this. So by just directly substituting this, we will get the proportion. In this case also we are getting same 46 and 54, minimal rounding of difference, no issues. So that's it.